Forget day trading highs and lows. Let's talk about building a steady income with options. The secret to generating consistent income with options lies in mastering a few key concepts, starting with understanding why options can provide income unlike simply buying and selling stocks. Options allow you to profit from time decay and premium collection. Our first cornerstone strategy is the covered call. Imagine you own 100 shares of a stock. You can then sell a call option against those shares. For selling this option, you receive a premium upfront. This premium is your immediate income. If the stock price stays below the strike price of your sold call by expiration, the option expires worthless, and you keep the premium, ready to sell another call. Next, we have the cash-secured put. With this strategy, you sell a put option while having enough cash set aside to buy the underlying stock. If the option is assigned, you receive a premium for selling the put. If the stock price stays above the strike price by expiration, the option expires worthless, and you again pocket that premium, with your cash still available. But income generation isn't just about selling options. It's about smart risk management. For covered calls, choose strike prices that you're comfortable selling your shares at. For cash-secured puts, only sell puts on stocks you'd be happy owning at the strike price, and ensure you have the capital. Consistent income comes from consistency. This means regularly applying these strategies, potentially on a weekly or monthly basis, depending on the options you trade. It's about building a predictable income stream. Finally, market analysis is crucial. Understand the underlying stock's volatility, news, and potential price movements to select the best options to sell for your chosen strategies. This isn't about predicting the absolute direction, but about assessing the probability of the option expiring out of the money to collect your premium.